For more on the market moves, let's bring in CNBC contributor Peter Boockvar, Bleakley Financial Group CIO. Peter, always great to see you. As I understand from the notes, Peter, you were also a little bit flummoxed in terms of what the jobs report conveyed, given the prior data, and you specifically cite a lot of data points from the Beige Book, which don't necessarily seem to back up the idea or the thought of a strong jobs market right now.
Right. Early September, when we heard the last Beige Book, if you look through all of the districts, they talked about, at best, modest job growth. In some regions, there was no job growth. You combine that with even right before the payroll number came out, the day before, the ISM services employment component was under 50. You have elevated continuing claims. So hiring is still okay, but it wasn't as robust as Friday's numbers implied. So I do think that investors need to look at the whole mosaic, not just take the Friday payroll number on its surface and say, oh, everything's great, Goldilocks, but piece it out with a lot of different things. And I think the economy is okay. It's very uneven. It's very mixed. There are parts that are fine and there are parts that are not. And I think people look at the economy as this holistic thing, like things are great or they're not great. It's very much more mixed than that.
And so all of this leads you to believe that that rates will actually go higher. Is that right?
Well, the way that I look at rates is take the 10. Well, let's start with the 2-year. The 2-year is up 40 basis points since the day before the Fed cut interest rates. 30 basis points of the 40 is higher inflation expectations. Now, that is in part because the Fed got more aggressive with the cut. Then you throw in the China news, this lift in oil prices. And back to the China news, you have copper prices, iron ore is at a multi-month high. And if you're a bond investor, you don't want to see the Fed slashing interest rates. You want them to be more diligent when it comes to inflation and not complacent. On the longer end, to me, the 360, 370 level that we sort of stopped at on the downside here was where the liftoff point was last July when the BOJ got rid of yield curve control and we went to 5%. So we held that level here over the past couple of weeks, and obviously it lifted to 4, because I think if you're the long-end owner of a treasury, you don't want the Fed to be too aggressive either, because that risks flaring up inflation, and that's not the thing that you want to see. I do think, though, there's the potential for accidents here. Guy mentioned earlier debts and deficits finally mattering. I think they do. All you have to do is look at the price of gold or the very choppy behavior of the dollar to know that maybe it does finally matter. And if the Fed is going to keep on cutting, long rates are going to go up. And that's one of the fears that I've had is just because short rates go down doesn't mean that long rates do as well. And we have the risk of them going higher. I mean, there's plenty of real estate people on the commercial side. And if you're a residential potential buyer saying that, oh, the Fed's going to cut interest rates, I'm going to get a lower mortgage rate. Well, that move has already happened. And now mortgage rates are obviously ticking up again.
Peter, real quick, and we've talked about, obviously, Chinese stocks over the last couple of weeks. I mean, 35, 50% moves in these names, which makes sense on the equity front. But what's happened in China, does that make the Fed's job more difficult? Because I'm of the belief that that's just going to sort of accelerate the possible, inflationary cycle that I think we're still in. Thoughts on that?
It definitely complicates that. I made it a point over the weekend to try to find every article I could to see what was the consumer response to all the moves the Chinese took to put a bottom in residential real estate. And things got busy again over the weekend. Now, I don't think Xi wants to inflate the housing market again. He just wants to have it bottom out. But there are signs that maybe it is going to be bottoming out. And if that's going to be bottoming out, you can argue that commodity prices are too. And that's why I'm very bullish on most commodities, and we're long a bunch of stocks in the space.